everyone, Stephanie O'Connell here talking about how to buy a home even when you don't have a full 20% down payment saved up. This video is sponsored by Unison Homebuyer, which is one of the 4 alternatives to saving up a 20% down payment I'm going to talk you through today. So 20%, that's the number I keep coming back to. And that's because conventional advice says you should have at least 20% of your home's purchase price saved up for a down payment before you purchase. But trying to save up for 20% of a purchase that is hundreds of thousands of dollars, maybe even more if you're like me and you live in a really high cost of living city, can be a major barrier. In fact, a 2017 survey by Apartment List found that 80% of millennial renters want to buy a home, but most say they can't afford to. And the 20% down payment is a big part of that. So I want to talk about 4 other options for buying a home even when you don't have 20% to put down. Okay, number 1, take advantage of any applicable homebuyer programs. If you're a first-time homebuyer, or if you have a certain profession or you're buying in a certain area, you may qualify for certain homebuyer programs that can help you during the purchase process. For example, federal mortgage lenders Fannie Mae and Freddie Mac offer mortgages with competitive interest rates with down payments as low as 3% to some low and moderate income families. The U.S. Department of Housing and Urban Development also offers alternatives like FHA loans, which may allow you to qualify for a mortgage with a lower credit score and a down payment as little as 3.5%. You can also check your state and city's website for information on housing grants and programs available in your area. There are also programs specifically for veterans, Native Americans, people buying in certain areas, and people working in certain professions like law enforcement and early education. As you search for programs, be sure that whatever you find is being officially offered through your state, city, or a reputable bank. There are plenty of scammers out there seeking to lure buyers into scams and expensive mortgages, so just be sure you do your due diligence. Number 2, pay the PMI, the private mortgage insurance. PMI is insurance that protects your lender if you default on your mortgage, and it's typically required when you put down less than 20% of your home's purchase price. Now, on average, PMI costs between 0.5% and 1% of your entire loan amount annually. So if you're buying a home with a $600,000 mortgage, for example, you can expect to pay an additional $250 to $500 a month in PMI, which is, yes, a lot of extra money that is not going toward building equity in your home. But if you live in a market that is quickly appreciating, it might make sense to suck it up and pay the PMI so you can buy sooner and profit off the appreciations you'd otherwise miss out on by waiting until you had a full 20% down payment. Of course, there are no guarantees with any investment, and your home might not appreciate. And if you've put the majority of your savings into your home and it loses value, you could not only find yourself cash poor, you could also find yourself in a situation where your net worth takes a serious hit. So to protect against that possibility, you might want to consider strategy number 3. Partner with an investment program. So if you're like me and living in a high cost of living area, you're probably familiar with the struggle of trying to save up for a starter home while simultaneously paying your sky-high rent, which is why some companies are coming up with new solutions to help home buyers overcome that initial down payment barrier. And one of those companies is Unison. Their Unison Homebuyer program doubles your down payment in exchange for a share of equity in your home. In other words, rather than giving you a loan, Unison invests in your home along with you. So you don't pay the company interest. Instead, Unison receives a share of the future change in the home's price, typically 35% of any appreciation in the home's price at the time it's sold. Now, the great thing about this alternative is that Unison only makes a profit if you also make a profit. If you sell at a loss, they share in the loss. The Unison Homebuyer program is also a great way to save money on PMI, private mortgage insurance. Again, that's the extra insurance you have to pay when you put less than 20% down on your home, which in a high cost of living area could amount to thousands of extra dollars each year. The other benefit of an alternative like Unison is that you don't need to sink as much savings into your home. So if you have other major life expenses that you're working towards while you become a homeowner, like a wedding or a new baby or your kid's college education, being able to double your down payment with Unison can mean saving some of your savings to fund your other life goals. Now, before opting into this kind of program or any other, it's really important to understand all the terms of such an agreement. For example, Unison charges a transaction fee of 2.5% of the amount invested to cover processing costs, and they also only share losses with homeowners if the home is sold at least 3 years after purchase. But they partner with you whether the value goes up or down after that. So take time to think through your particular circumstances and assess whether a home ownership investment program like this could be a better fit for you. Unison's program specialists can help answer any questions you might have and walk you through the process. Now, to learn more about Unison specifically and whether it might make sense in helping you purchase your home, check out the link in the description below. Finally, let's talk strategy number 4. Borrowing money from a friend or family member. Now, I know that not everyone is in a position to be lending big chunks of money to their loved ones, and even when they are, it can be an uncomfortable conversation to have. But with the right approach, borrowing money from a loved one to help finance your down payment can be a win for everyone involved. The average rate for a 30-year fixed-rate mortgage has been hovering around 5% the last few months. By taking out a loan from a family member, you can save money by negotiating a lower rate, saving you money over the life of the loan while helping your loved one earn interest on their money in the meantime. Now, to help avoid the potential awkwardness of asking your loved one for a loan, come at the conversation like you might any business proposition, stating exactly how much you need to borrow, how you will repay the loan, on what schedule, and at what interest rate. If your family member is receptive to your proposition, you can draw up a contract with the terms of your agreement. This kind of clarity can help make sure that financial assistance doesn't turn into financial or emotional resentment, and can help keep you accountable to your agreement. So while saving up a 20% down payment has long been a benchmark for when you can afford to buy a home, the reality is there are plenty of alternatives that can help you buy a home with as little as a few percentage points down. And if you're in a hot and growing real estate market with a stable income and a bit of savings, it might make sense to jump in while you can rather than to wait until you're priced out of the market. Just be sure to assess all of your options and do your due diligence before making any decision. And remember that your home is one of the biggest purchases you will ever make. So it's worth spending a little extra time to do your research and talk through what option is ultimately best for you. Thank you so much for tuning in. You can learn more about the specific resources we talked about here by clicking the links in the description below. If you liked or learned something, please hit the thumbs up button and subscribe for more money talk and tips. I'll catch you next time.